For more insight on early morning activity, we're joined by Michelle Schneider. She's Partner and Director of Trading and Research Education for Market Gauge. So Michelle, thanks so much for joining us. All major averages look to snap a 3-week streak of losses this morning. So what's your read on the markets right now, and what are you watching next week?
Well, what's so interesting about the market is that you can almost break it down into different questions and what the answer looks like based on price activity. So one question is, things are really bad. Could they get much worse? Things are better. Could they get much better? Things are pretty good. Can they get better still? And is it time to get worried? And that seems to be really the complexion. If you look back from COVID, right? Started out, things are bad. Could they get much worse? No. Then 2021 was, okay, things are better. Can they get much better? Yeah, maybe. Oh, wait, now things are too good. Can they get much worse? Yeah. And so right now, that's why you're seeing so many talking heads going from, on one level, we think 20% lower from here. On the other level, this is a generational buy. And so when you keep that in mind, you have to really right now think about what the market is doing. And it's been very interesting from a technical standpoint, because as we sold off after the Fed speech from Jackson Hole, what we saw was, A, we didn't quite get as bad as we thought. We didn't go back down to the June, July lows. And a couple of sectors held up well. Transportation being one that I like to key on right now because it's a great representation of demand versus supply. And of course, when we talk about demand versus supply, we're not necessarily talking about the way we would say in terms of raw materials, more like companies having enough supply to meet the demand. And of course, they have to continue to produce to meet that demand. So right now, the transportation sector is showing that things aren't as bad as we thought. And now we have to look at the question, can they get much better? And that's why you have to be watching this S&P right now. This area of 4020 is exactly where a 50-day moving average is. Can we get through 4100? That will be the next hurdle.
Now let's keep speaking about next week, which we're going to get CPI data. Do you see enough evidence in the economy that inflation is actually trending downward?
I mean, it wasn't a good color.
Well, there's going to be aspects of inflation that will definitely turn downward. We've seen that already. Supply chain issues that we had throughout the seas, when we were coming out of COVID, that has certainly helped. So there's been more inventory delivery. In terms of raw materials, natural gas obviously has continued to hold up, even though it's come down, and Europe is still going to have problems. But yet oil's come down because of recessionary fears. So you probably will see somewhat softer CPI, but that's, to me, why we're seeing this rally right now, is because we had some Fed comments that said, hey, you know what, we think inflation's going to come down. We may not have to be as aggressive past 3.75 or 4% in terms of the Fed fund rates. And the TLTs are actually rising, which means yields are falling, and now the dollar's relaxing. So I would say the expectation is CPI is going to be relaxed. However, we don't want any policy mistakes or great weather concerns like you were talking about at the start of the show with hurricanes coming in. Then we can actually see that whole thing flip again. So we're precarious right here.
Now, how do you see the Fed reacting if we do have that drastically lower print?
Well, the question has been 50 basis points or 75 basis points. Right now, the consensus is still very strongly in favor of the 75 basis points. Would they go to 50 if the CPI came down? Personally, I think that would probably be a policy mistake because it would be really almost myopic compared to what can happen in the future. Still, we have a long winter ahead of us. But nonetheless, 50 basis points might be more likely if they think that things have really peaked.
Now, which areas of consumer staples do you predict climbing in the next few months?
Well, we're looking at things like Walmart and Costco, obviously the stores that are still more discounted. Consumer discretionary got really very beat up and is still actually not the weakest sector on the board. Semiconductors is still the weakest sector, but still really down there weak. So in terms of consumer staples, I think these lower gas prices are giving opportunities not only for airline stocks, but even for restaurant stocks. And then, like I said, shopping where you can do more as close to wholesale shopping, Target would being another one. That's really kind of what we've been watching right here in terms of the consumer staple market.
Now let's move overseas. So the new British Prime Minister, Liz Truss, is announcing a cap on energy bills to combat the cost of living crisis. Now this comes as as Putin is threatening to cut off oil and gas exports to the West. So how do you see this impacting energy markets?
Well, Rochelle, getting back, this is the classic things are bad, could they get much worse conversation, right? So you had a few things, right? First of all, capping the prices, number one. Number two is also capping the usage. Number three is raising the interest rates finally in Europe, Lagarde raising 75 basis points. So I think right now, the philosophy is, even though, yeah, of course, it could get much worse, the overall philosophy you're seeing in the market, the British pound's bouncing a little bit against the dollar, emerging markets, which have been totally beat up, coming in a little bit better, is that maybe they can't get much worse. And that's the interesting thing about the psychology of all markets, right? Because they're forward thinking. They're reactive to a degree, but then they look beyond. So, of course, who knows what's going to happen with Russia? Who knows how bad the winter is going to be? But for right now, I think the overriding feeling is maybe this is as bad as it's going to get.
The Department of Commerce is seeking applications for funding the chip sector, and this all comes at this time where NVIDIA and AMD were ordered to stop exporting chips used for artificial intelligence to China. So what's your take on the strength of the semiconductor industry in the U.S., and what could that mean for commodities that are needed to make these chips?
Great questions. Well, first of all, yeah, I mean, certainly having a focus on having more dependency here rather than on foreign chips is a good thing. I mean, actually, we have decreased our imports over the last couple of weeks, which has been a good thing. There's concern, of course, about government spending because that can turn out to be inflationary and that could be a factor. But overall, it seems to me that if the semiconductors right now, which is really the growth area, can hang in there. And if we don't get into a situation, and I did read today that China is saying they're not going to have any issues with Taiwan for at least the next 5 years. I don't know how those facts come up. But anyway, that's what I read. So again, perception. Then I think trying to create these semiconductors could put a strain on these raw materials. So you have two inflationary potential factors here. So, you know, sometimes the best intentions, right? So you could have a strain on already very rare raw materials like rare earth minerals, silver, copper, some of the other things that are involved in creating semiconductors, water. Obviously, we have some more drought issues all over the place. And two, it can mean the government spending, in spite of its good intentions, could actually wind up being inflationary. So it's going to be a dance. Overall, though, yeah, it would be nice to see the United States be more independent when it comes to not just oil and gas, as we've been trying to do, but also obviously semiconductors.
Now, the topic that's on everyone's mind, are we or are we not going into a recession? So which industries are you following for incremental gains or signs of a rebound?
Well, in terms of recession, I really don't believe that we're going into a recession that's going to be anything deep. I've been using the word stagflation, because we've actually seen some evidence of some, at least relative growth, nothing too great, like the ISM numbers that came out last week, the labor market still being relatively strong, even though the housing has come down and the mortgage rates have gone up. We're not looking at a crash like 2008. But stagflation is something that means that inflationary levels of costs of goods still high while the economy kind of limps along. So if you want to see that reverse, if we're going to look for any economic expansion at all, that's why I think you have to look at things like the small caps, industrial manufacturing, which is very U.S.-centric, the transportation sector, you know, companies like UPS and FedEx and airlines, how they're doing in the United States, are they growing? And then perhaps we can actually sort of get that soft landing. That's, of course, the optimistic case. And then in a couple of years, once everything sorts out with Mother Nature and raw materials, start going more into a period of growth. That's the best case scenario. So those are the areas that we're watching right now.
Now, I know that you're very bullish on the idea that we're going to go into that stagflation period, but one of the questions I've always had is we're seeing consumers pull back on spending. We're seeing employers actually not increase salaries because of fears of this downturn. Do you think we're going to see that balance out, especially as we head into the holiday season? Are we going to start seeing people spend more again?
Well, people are already spending money in restaurants and travel. Airlines have been at record highs, pre-COVID record highs. Restaurants are coming back. But I did also read a story that people are starting their holiday shopping in October because they want to spend little bits of money that they're planning to charge to their credit card so that by the time the holidays come, they've already, instead of doing everything last minute, have accumulated their gift giving. And, you know, I think people will want to give gifts. I think people will want to spend money and even willing to go into a little bit of debt for it because, let's face it, people want to feel good. There's just so much doom and gloom around all over the place. What do you do in those times? And what do Americans do in those times is generally they spend whether they have the money or not. So, yeah, the stagflation means that there could be a price to pay for that. We may see an initial surge, let's say, in consumer spending. And in terms of the job market, you might see more jobs coming in. That's not the problem. The problem is people don't want to work. We have 11.3 million jobs still available. So this labor market is at a level we've never seen before. Can the stores get these people to come in that they usually hire temporarily around the holidays? These are all going to be the questions to be seen. So that's why I say keep your eyes really on the retail sector, particularly the consumer discretionary, the transportation sector, which will really give you the pulse of demand, and then, of course, the small caps, because you'll be able to see whether the manufacturing and the industrial side of the U.S. economy is actually growing to meet any potential demand. And if that doesn't happen, I wouldn't be necessarily so bullish in the market. Recession could be possible, but I also think that could mean another super cycle in commodities could be coming, unfortunately.
Well, thanks for joining us this morning. That's Michelle Schneider. She's Partner and Director of Trading Research and Education at MarketGauge.